Greetings, traders from all around the world. Thank you for joining me yet again. Chris here, bringing you another In-Depth with Chris episode, where today we are going to cover leading and lagging indicators. It's my pleasure to bring this to those of you that are aspiring technical analysis traders to let you know what the different options out there are as far as the categories of indicators. So without further ado, let's dive on into it and talk about what those are, as well as provide some examples at the end of all of this where I'm going to go ahead and apply some of the indicators, the most common of either category, to a live chart so you can see exactly what they look like. So the indicator itself, the word indicator, what is that? An indicator is a tool that is used by technical analysis traders to manipulate and mold price data into a potentially more digestible manner by generally using some type of mathematical formula with the goal of giving the trader an edge while they forecast market direction. So the long story short, it's just different tools that we use to help interpret what we are seeing on our charts in an easier manner to get us ahead of the competition. Now we have a visualized leading page that I wanted to bring to you guys with an image here to show you just what a leading versus lagging indicator scenario would look like in relation to price, just to understand the concept here. So with a leading indicator, if we work on visualizing this, the lighter gray line is going to represent the indicator's read on price as regard to what price is going to do potentially. So as we see here, the price trajectory as the indicator is providing us is actually going up here. So we see this going up on the indicator before price itself actually has risen. It shows it going up and actually dumping then before price has actually began dumping over here, as you can see. And this gives us that predictive nature, and as such, the name of leading was more or less coined to leading indicators. It's the idea that this type of an indicator will provide us some insight into what is about to happen before it actually happens. A rather simple concept, but it is important to understand nonetheless. Now if we switch on over to visualize a lagging indicator, the chart looks a little bit different. Now remember, the dark line is actually going to represent the actual price hypothetically. So we would imagine that with a lagging indicator, we'll notice that there's actually a lag here where we are seeing the indicator show the rally in price after the rally has already happened. So the indicator does actually lag behind price, and generally the way this works is by using historical data such as averages and various things that we are obviously going to talk about. Now, comparatively between the two, leading indicators up here react to prices quickly, which can be great for short-term traders, but this makes them prone to giving out false signals, and sometimes this does happen quite frequently if we don't have our P's and Q's in order. Now, this happens when a signal indicates it's time to enter the market, but the trend promptly reverses. We've all been there. It's not an enjoyable feeling. In contrast, lagging indicators are much slower to react. This means that traders might have more accuracy but could be late when entering the market. So everything is a give and a take in the trading world. With the leading indicators, we have the potential to nail a perfect trade and ride the entirety of a trend. But with the lagging indicators, we have a large sample size of historical information that is being analyzed to provide us arguably a more accurate read on what is actually happening in the market, but it can cause us to jump into the position a little bit late to the party. Now, that doesn't mean that great trades can't be found with either of them. Both of them can produce awesome trades, and both of them can be failing to the trader when used incorrectly as well, or not used in conjunction with other technical analysis or just common old price action. Now, as far as leading examples, let's take a look at a few of these. Now, these are going to be the various leading indicators out there that are some of the most common leading indicators that you'll probably run into as you scour the web or just progress throughout your trading career. Now, number one to get us started off with is actually going to be the relative strength index. Short is going to be RSI, and that's how you're going to hear most traders talk about this. Very rarely will someone actually say relative strength index because it's a bit of a mouthful. Now, the RSI is a momentum indicator that attempts to key a trader in to potentially overbought and oversold situations in the market. When the RSI provides a signal, it is interpreted that the market will soon reverse. This predictive nature makes this a leading indicator by allowing traders to enter or exit before the move occurs, and this is the requirement of being a leading indicator, to potentially give the trader an opportunity to get in before the market rallies or to get in for the sell before the market goes on for the decline. Taking a look at another leading indicator example, we have the Williams percent range. This is going to be one of those indicators where, once again, you're not commonly going to see it spelled out in full. Instead, you'll see the abbreviated version, which is right here. So the Williams percent range, more commonly known as the Williams percent R, is very similar to other oscillators with one key difference. The percent R works on a negative scale instead of a positive. So a read would fluctuate between 0 and negative 100. And this uses negative 20 and negative 80 as the overbought and oversold signals respectively. This means, in short, that if we were to witness it oscillate down towards the negative 80 mark, we would be anticipating the market to begin rising at some point, as it would be considered by the indicator to be an oversold scenario. And conversely to that, if the indicator oscillated up towards negative 20, then we would be expecting some type of a decline in the market, as the indicator is giving us a read of an overbought scenario. Our next leading indicator example is going to be one of the most common ones out there, and that is the stochastic oscillator. The stochastic oscillator is a fun one, and it is commonly coupled with a lot of other indicator pairs out there, so it is definitely one to take note of, those of you that are in my newer category. Last but not least, the stochastic oscillator is based on the idea that the market momentum changes direction much faster than volume or price, so it can be used to predict the direction of the market movements themselves. If the oscillator reaches a reading of 80 or over, the market would be considered to be overbought, while anything under 20 would be thought of as oversold. So more or less the inverse of what's going on with the Williams percent range. As we switch on over to some lagging examples, we'll find a broader category of indicators. More indicators fall under the lagging category than the predictive leading category, as you'll find as you progress throughout your trading career. Now, our number one and by far and away the most common indicator, in my opinion, that exists and has existed for quite some time out there of either category is going to be a moving average. Moving averages are arguably the most used indicator on the planet. Moving averages represent lagging indicators at the core, as they are a line that is simply plotted on an average of historical data. Buy and sell signals are generally created for traders based on shorter and longer period crossovers. And this is when the moving average just simply crosses over another moving average. These have been around for a long time, and this is a strategy that has been used for a long time. And once again, some of the strategies that have survived for as long as they have survived for a reason, so they're always worth paying attention to. It's not overly common for traders to use nothing but a moving average when trying to generate signals, meaning they're not using any other technical analysis or price action, but it does still happen. Another lagging indicator example would be our Bollinger Bands, and that is one of my all-time favorites. The Bollinger Band is a lagging indicator naturally due to the fact that it is based on a 20-period, simple moving average. The two outer bands that are also in conjunction to that 20-period moving average represent the positive and negative standard deviations from the center of that simple moving average. When volatility increases, the bands will widen, and when the volatility decreases, the bands tighten. So price reaching the outside of the bands is widely considered to be a trigger point to expect price to return to inside the bands. It's said that over 90% of the time, price should be trading inside both of those bands, so people get quite excited when they see price move to the outside of either end. Next, we have things that are a curious case. And what do I mean by a curious case? Well, we have indicators that almost fall into both categories, and one of those is going to be this long-winded word here, that is the moving average convergence divergence, which otherwise is just simply known as the MACD. The MACD represents a lagging histogram style indicator to some, keyword to some. The MACD is based on moving averages and as such rightfully earns a place in the lagging category. The MACD is made up of two moving averages, signal line and MACD line, overlaid on a histogram chart. Signals are generally generated when the moving averages cross each other after the trend is already in motion. So the MACD is another indicator that uses that crossover style of a strategy, usually at its core. Now, continuing on with the curious case, almost messed up the question mark there. Despite earning a place in the lagging category, the MACD is also considered to be capable of being a leading indicator as well, due to the predictive potential of the histogram. The histogram is sometimes considered a leading indicator as it is used to anticipate signal crossovers between the two moving averages. So the bars on the histogram represents the difference between the two moving averages. As the bars move farther away from the zero line, it means the moving averages are moving farther apart. Once this expansion is over, a bump appears on the histogram, which is a sign the moving averages will tighten again and a crossover might occur, touching the predictive category as well. So as we see with the MACD, it has both predictive as well as lagging properties about it, so it is a rather curious case because depending on how the trader chooses to use it, you can find it in the lagging or leading category. Now predominantly, you're going to find the MACD categorized more so as a lagging indicator. Now let's go ahead and take a look at these on the chart. With the help of the Finamark platform and the E-mini S&P 500, I'm going to show you guys how to quickly apply these indicators as well as let you see what they look like so you might be more familiar with them in the future. Now remember, if you're on a different platform, they may be different to navigate to. Up here at the top, we have a Show Indicator Options button. I'm going to click that right off the bat, and we'll get started by plotting our leading indicators first. The first one that we talked about was the RSI, and in order to do that, because it doesn't overlay price, we need to add a new section here on the right-hand side. After I've clicked this button and we have a second section, I'm going to scroll down to the R's and I'm going to click on Relative Strength Index. If I want to adjust any of the settings with this indicator, I'm going to click the cog wheel. We won't do that at this point. And we're going to go ahead and close it off. And there we are. We have an RSI and we can adjust the screen up and down as we see fit. Next, let's go ahead and get rid of that and we'll move on to the next one. The next indicator that we talked about was the Williams percent range. So we're going to scroll down to the W's. Here she is, Williams percent range. Go back to the main screen, and now we have a Williams percent range, which is going to be obviously a negative oscillator, fluctuating generally between a negative 20 and a negative 100. The next one on the chopping block was going to be our stochastic oscillator, probably one of my favorites for the leading indicator category, and that's obviously going to be in the same category down here, second section, stochastic oscillator right there on the center screen. I'm going to click that, and here we have a stochastic oscillator where we see a couple lines crossing back and forth over themselves, once again fluctuating, just like the Williams percent range, but this time with the positive numbers. Next on the chopping block, we're actually going to flip on over now to our lagging indicators category. was the moving averages. The moving averages are some of the easiest to use indicators out there, and I'm sure many of you are already familiar with them, so we won't take too much time. To add a moving average, we're going to go to the center category because it does overlay price, and we're going to click on simple moving average right here, and then we're going to go back to the main screen, and voila, we have a moving average. If we wanted to change the period, once again, we would just click that cogwheel. The next on the chopping block after the moving average would be the Bollinger Bands, another one of my favorites. Getting rid of the simple moving average and adding a Bollinger Band, that's going to be at the very top because of alphabetical order. Clicking that and going back to the main screen, we now have ourselves a Bollinger Band where it's going to show the outer bands and giving us a setting opportunity to go ahead and show the center, which is going to be what the deviations are based off of, is usually how it's going to be displayed. My settings are slightly different due to my personal preferences. And finally, moving along, we have our MACD, which was our curious case. Now, in order to add the MACD, we do still need to add a second section and go down to the M's, where you'll find moving average, convergence, divergence. After we've added that and return to the regular screen, you'll see the histogram with the two moving averages crossing back and over themselves as they move along. The MACD is a lot of fun because of its predictive as well as lagging nature that it can provide to a trader depending on how you interpret the information. To sum it all up, it's important to remember that a leading indicator is just a tool that is designed to anticipate the future direction of the market, while a lagging indicator is a tool that gives a signal once the price movement has already started. The leading indicators usually react to price quite quickly, but it makes them prone to giving out false signals, while the lagging indicators can be more accurate, but they are slower to react. It doesn't matter what you choose and what you become good with, the idea is to use what feels like it clicks with you personally the best. It is going to be a matter of personal preference, and whatever you understand the best will most likely be what you have the most success with. But other than that, good luck everybody and happy trading. Thank you for joining me for another presentation, and make sure you click the like and subscribe button at the bottom to make sure that you get more updates when we come out with these videos for you guys. Thanks again guys, and happy hunting.